Hello, everyone. Good afternoon. Welcome to this webinar. Since time is short, I propose that we start Swiss time. And it's my pleasure to welcome you all to this webinar that marks the launch of the Extractive Commodity Trading Report 2023. My name is Gilles Carbonnier. I'm a professor of development economics at the Geneva Graduate Institute of International and Development Studies. And it's my pleasure to be moderating this webinar. So the report that we are launching today has been produced by the World Resources Forum together with the Responsible Mining Foundation. And this is actually the second edition of this report, which allows for some comparison over a 2-year period. I think that this report deals with absolutely key environmental, social, and governance issues in the commodities trading sector, including due diligence in the supply chain. And this is highly topical as trade in oil, gas, minerals, and metals has a very significant impact on global supply chain, on making energy and other critical commodities available, but it's also absolutely crucial for commodity-dependent developing countries to be able to mobilize domestic resources to finance for sustainable development. So the Extractive Commodity Trading Report relies primarily on publicly available data and looks at 25 companies with a focus on 4 domains: corporate governance, human rights, illicit financial flows, and the environment, further including supply chain due diligence. So, ladies and gentlemen, we have a great lineup of speakers with us to introduce and discuss the report. Their full bios is made available to you, so I will just introduce them, mentioning their current affiliation. First, we will hear Hélène Piaget, who will set the stage and put the report in context. Hélène is an independent advisor on sustainable supply chain and responsible extractives with Vantage Stones, and she was previously the CEO of the Responsible Mining Foundation. We will then hear the lead author, Dr. Robin Gilly, who will introduce the Extractive Commodity Trading Report. Robin is project manager at the World Resources Forum. We will turn then to 3 panelists who will react and comment on the report. First, Nicole Hanson of the London Metal Exchange, where she is manager for responsible sourcing. Second, Juhani Grossman of the Basel Institute of Governance, where he leads the Green Corruption Program and serves as senior advisor for Central and Eastern Europe. And third, but not least, Wangi Kimoto, a human rights lawyer and associate with the Institute for Business Ethics at the University of St. Gallen, where she's also engaged in a doctoral research. You, the audience, you will have then the opportunity to put forth your questions and comments, and I invite you to do it as the panel goes on. And we will use, you can use the Q&A function, which is at the bottom of your screen on Zoom, to raise your questions, and I will try to collect and select a number of them for the time allocated for Q&A. So without further ado, let's get us started. I now pass the floor to Hélène Piaget, who will put the report in context and set the scene. So Hélène, you have the floor.
Thank you, Gilles. So in 2021, the Responsible Mining Foundation published the first Extractive Commodity Report. And for me, it's pleasing to see the second report now as a collaborative effort with the World Resources Forum, whom it is hoped will continue these reports in the coming years. And congratulations to the team, including Robin, on this panel. Although commodity trading plays a critical role in the global flow of commodities, as we've just heard, it remains a fairly opaque industry within global value chains. So understanding how commodity trading companies conduct themselves matters, not only to the integrity of the international financial system, but also to the economic, social, and governance well-being across all societies. This report is noteworthy, especially in the context of today's shifting geopolitics, as it includes companies across the geopolitical divides and covers traditional privately held and public trading companies, as well as some of the international oil companies or IOCs, whose trading activities, as recently noted by the Financial Times, can outperform the traditional trading companies themselves. So this study levels the playing field across all of these by assessing these companies from various jurisdictions on the same basis, namely that of society expectations on the aspects of human rights, governance, financial flows, and environment. Which brings us around to the UN Sustainable Development Goals, or SDGs, for 2030, of which we hear rather little these days, and the role that commodity trading can play in supporting just social and economic development on a shared planet. This is the context in which this report was initiated in 2021, now repeated, and still bears relevance today. And now I look forward to hearing the insights of today's panelists. Thank you, Jim.
Thank you very much, Helen. I now turn directly to hear the lead author of the report, Robin Gilly. So, Robin, I pass on the floor to you.
Thank you very much. I am a part of a team who authored this report, so this was really a team effort, and I will now share my screen to show you some results, and that's the last slide. Here we go. So as was already mentioned, the RMF conducted their first assessment on the ESG due diligence and transparency of 25 commodity trading companies in 2021. And it was found over the last 2 years that there was a sustained level of interest being paid to this report, including the observation that some companies were increasingly making public documents that align with the assessment's framework. So given that there is now an increasing interest from governments, financiers, from consumers on transparency in ESG issues, the Responsible Mining Foundation and we at the World Resources Forum decided to partner together for this second edition, as we know that repeated assessments can drive real change in the sector. So as was already mentioned, the study is evidence-based. The scoring relies on evidence that is for the most part sourced from the company's own public disclosures. Thus, this assessment reflects the most recent evidence of the existence and disclosure of due diligence and transparency policies and systems. Thus, it is important to point out that any low score that is found in the report can be a product of a lack of public disclosure rather than a lack of policies or practices. And because of this, because it focuses on policies and practices, the assessment thus offers companies a gap analysis or an analysis of their current performance and indicate where improvement is most needed. Now, as was also mentioned, 25 companies were assessed in this edition, and these are more or less the same companies that were addressed in the first report, and it includes various types of trading companies, and as you can see in the map, it covers a wide geographic area. Now, this assessment levels the playing field. And what we mean is that it covers publicly listed, privately held companies, as well as state-owned enterprises by applying the same benchmark to all these companies across all geographies. Thus, it seeks to ensure the companies are equally held to account, no matter how they are governed, where they are based, or how they conduct their trading activities. Thus, with that very brief introduction, I would like to introduce to you some of the key findings in our 2023 Commodity Trading Report. So here you see a graph of the overall basic due diligence on one of our 4 thematic areas. In this case, we have the example of human rights thematic area. Now, each company is represented by 1 bar, and they are plotted against the percentage of points. And you can see on the top a benchmark, what we like to call this collective best score. So what exactly is this? Well, this is a score that a company could reach had it achieved all the best scores attained for every indicator and every metric question in each thematic area of the assessment, And in this case, we are talking about the thematic area of human rights. Thus, you can think of this score as a hypothetical company in our assessment. In other words, the various companies leading on each issue have collectively proven together that a stronger performance on, in this case, human rights, is currently possible on these basic issues of due diligence and disclosure. Now, as you can see here, there is a considerable scope for improvement, as is shown by the wide gap between the company's current performances and this much higher collective best score value. Now, on the issue of human rights, you see two companies scoring over 70% due to their relatively well-developed systems for identifying, assessing, and addressing risks in their human rights abuses in their supply chain. But you can see most companies scoring at or below 40% and an overall average of about 32%. Now, this scoring gap lies arguably in the most important aspect of due diligence systems, which is the tracking and the performance and taking responsive action to ensure efficacy of their systems. Now, if we look at the overall results of all four of our thematic areas, you see again here the same exact graph for human rights, now together with the overall results for our other three thematic areas of corporate governance, financial flows, and the environment. Now, if we were to zoom into the thematic area focused on financial flows, we see that these show the weakest results by far, with an average score of only about 19%. Though this was an improvement as compared to the 2021 assessment that saw an average of only 16%. Now, the collective best score of this theme, while it is the lowest of all of our four thematic areas, it is still at 72%. Thus, a significant gap lies between the average score and what the companies show is collectively possible, currently possible on these issues of financial flows. And again, just as before, the low performance here is due in part to, for example, a lack of publicly available data on payments to governments and state-owned enterprises in producing countries, for example. There were, however, some very promising improvements made since 2021, and this includes some voluntary disclosures on those financial agreements with governments, some voluntary disclosures of country-by-country tax payments, and revised supplier codes of conduct that now contain clearer requirements. So we did see improvements in the financial flows since 2021, slight improvements. Now, if we are to look at the thematic area of the environment, here we see a summary slide of the main due diligence indicators within this thematic area. And what we see on the top bar is these commitments to avoid, minimize, address any adverse environmental impacts that the companies contribute to, followed by expectations for suppliers regarding prevention, avoidance, and mitigation of environmental risks. Next would be the systems to identify and assess environmental risks in companies' supply chains. And the last bar would be that tracking and reporting on performance on supply chain, environmental risk assessment, and mitigation. Now, without even having to read the words on the slide, you can see we have a lot of companies committing to minimizing environmental impacts. But the further we go down the slide to those action items about identification of risks and tracking and reporting, we see the company's scores begin to score lower. So what we are seeing here is that the company's commitments to in the environment are not being operationalized, or at least this operationalization is not being publicly disclosed. So if we were to look at this same graph at the other thematic areas, for example, of human rights and the financial flows, we would see the graph looks very similar. So in the report, we identify some immediate areas that companies could look to for improvements. Now, we like to call these easy win opportunities. And again, we're not just talking about these 25 companies assessed. We are talking about companies in the commodity trading sector in general. And so we will first start with companies can formalize those commitments on some of these basic issues within the thematic areas of human rights and financial flows and the environment, for example. We can encourage formalization of those commitments to some of these basic due diligence issues. Companies can adopt and adapt the models provided by their peers. Now, every piece of evidence that was used in this report to make this assessment is provided on our websites in a documentation library. And this library can now be queried, can be searched, and any company, commodity trading company, can look through that library to see how their peers are issuing some of these very important environmental due diligence or due diligence on any one of these thematic areas. Companies can also embed suppliers' expectations into their contracts. We have seen some in this assessment, we have seen some supplier contracts that now contain these expectations. And finally, the last 2 points here will actually go together. Companies could report and publicly share what is already being tracked. I make the assumption that some of these issues on environmental, I keep saying environmental due diligence, but it's all due diligence within each of these thematic areas. I think that these some of these issues are already being tracked. Why not publicly disclose some of these tracking to be more in the name of more transparency, and in that regard also consider where confidentiality may actually be unnecessary. In some of these issues, we have transparency issues. Some of these companies who have perhaps on certain issues more transparency are now really debunking this myth that this disclosure, this transparency is bad for business. In fact, many of these companies are still very profitable and are not losing market share. So companies could consider assessing where their confidentiality is actually unnecessary and reporting in public issues that are already being tracked. So that's just the summary. I would like to thank you for your attention, and I hand it back over to you, moderator. Thanks.
Thank you very much, Robin, for the summary of the report and also the indication of where we can find more information. Very useful. I'll now open the panel conversation, and I will invite each of the three panelists to briefly react, mainly asking what are the key takeaways and the chief value added that you see in that report, seen from your own area of expertise and practice. And for that, I will first ask Nicole Hanson of the London Metal Exchange to share her remarks, feedbacks on the report. So please, Nicole, you have the floor.
Thank you. Thank you. Hello, everyone. Yes, so I did give this report a good read, and then there are three things that I really felt stood out for me and for our program. So the LME has implemented a responsible sourcing program, and we're in our second year of implementation. We're looking at producers of metal around the world and basically base metals at this stage. And so when we were reflecting at the end of last year of how did that first year of implementation go, I noticed a very similar kind of takeaway from this report, which makes sense as metals are traded, right? It makes sense that we would see similarities, but it's also interesting just to note because we focus specifically on this one OECD guidance for the minerals sector, and this report from the World Resources Foundation is much broader, right? And so seeing the similarities was really interesting. The first point was that the policy and commitments do seem to be coming. So we see a lot of companies that have those policies and commitments, but we agreed with the result here that the risk mitigation and the actions taken and then reporting on what you found in your company and what you found in your supply chain is a little weaker. So agree on that stage of like, we're in that stage of committing and getting there, but we're still wanting to see some progress on risk mitigation and kind of the actions taken by companies. And we did a webinar 2 weeks ago with a standard in the metals space, and they had the same result. So it seems like globally, we're at this stage where we're seeing commitments, and that's really good. We're glad to see that progress. And then where we need to see more is on the what actions are being taken to address these risks, and then the sharing of how that's going. So that's interesting to note on. The second point was, in the beginning, Robin mentioned how this was an analysis of kind of the reporting, but not necessarily the effectiveness. And that's something that I hold really close to my heart, because we have a program, right? It also asks companies to report what they're doing, but it's really challenging to measure, is this working? You know, and do we end up in this situation where we see a lot of papers that say a lot of things, but we're not actually seeing change on the ground? So it's a call to anyone listening, and anyone working in this space. How can we collectively measure, impact on the ground of how are we getting better? Is this improving? And I think that's still a challenge to say, even if we have beautiful systems and beautiful reporting, how can we see if it's really being effective? So it's a great step, but I'd love to see that effectiveness measured somehow. And we're working on that as well with the OECD and some of their tools that they've created in the past. And then finally, my last kind of quick point here was just to highlight that document library, because I think we do hear from some producers that they're just not sure how much they're supposed to disclose and what's important, what's interesting to stakeholders, because it takes a lot of work, right, to create these reports. And so by having that document library where they can see what other producers or traders are disclosing and how they're doing it and what's interesting, I think that's really, really valuable. So thanks to this team for creating that document library, and just a shout out to that section, because that really resonated with us over here at the London Metal Exchange. And now I'll pass it off.
Thank you, Nicole. And I remind all participants that you can start using the Q&A section to place your comments and questions for the conversation later on. So second, I turn to Juhani Grossman of the Basel Institute on Governance. You have the floor also to react on the report.
Thank you very much. Thank you for having me. And allow me to first of all congratulate RMF and the World Resources Forum on the second edition of the first one already being a fantastic report and the second one being similarly great, and the ability to continue doing this work. I think it's really, really important and really crucial. So for us, it's particularly relevant because we focus at the end user. So we focus on regulators, helping them mitigate their corruption risks in this space. And we focus on law enforcement, building their capacity to follow the money in corruption-related environmental and natural resource crimes. And so that's of course relevant for us, because with this report, we see how the commodity traders present themselves, how they assess themselves, and of course, having this sort of cross-sectoral comparison is really useful for us. And so this is, I think, especially crucial. It's crucial anyway, but it's especially crucial in a current time when critical minerals or green minerals are becoming a hot topic of discussion. In fact, I'm here at the Global Anti-Corruption and Integrity Forum at the OECD. We're just coming off a panel on this particular issue that again highlighted the role that commodity traders play in this space. And I think it's no exaggeration to say that they're not considered the most transparent and accountable players in this emerging space. And so having this sort of broad suspicion, perhaps even a little bit of a stigma, analyzed in more detail is really important, because after all, the devil is in the detail in this regard, and so to see where there's progress and where there isn't progress is super valuable. So for me, a few things also stood out in the report, looking at the anti-corruption and the good governance elements. So the first, and I think this is the same for commodity traders, but also for others, is that the sort of including clauses in contracts might help with some legal liability issues, but doesn't actually address the issues, because all players, including commodity traders, are not in a position to go beyond the first level. Some rare instances look at the second level, but that's it. And of course, we're looking at many layers, right? And so pushing down these clauses doesn't necessarily have an impact. Maybe also referring to Nicole's point about where do efforts we are putting in place actually achieving impact. I'm not seeing this yet in our work. I also find the element about self-regulation and self-reporting quite interesting. I think we're clearly seeing that there is more regulation necessary that requires this, because obviously the companies aren't disclosing it themselves. And I'm talking in general, never mind about beneficial ownership, which is sort of a perennial evergreen challenge in this sector. One thing I was particularly surprised about is that the finding that 40% of commodity traders don't have anti-corruption commitments, which in our space is considered a pretty sort of entry-level activity to take. Never mind actually implementing them, but not taking the commitments is a surprise. And then I also like the finding about the incorporation of ABC measures or the lack of incorporation of ABC measures in the executive compensation and KPI systems, especially in such a compensation-driven sector as commodity trading. I would imagine that things that aren't monetized in terms of income probably don't get prioritized. And so never mind the fact that regular trainings are rare and things like that, but if there is an opportunity to make it more of a KPI, I would imagine that will make a big difference. And the fact that it isn't, frankly, isn't a surprise then, that as the report also says, that 1/3 of the companies have been subject to anti-corruption investigation. So thank you again to the authors for a fascinating report that gives us really useful insights. And I look forward to seeing how the commodity traders respond to it as well. Thank you.
Thank you, Yohani. So now I will turn to Wangi Kimoto of the Institute for Business Ethics of St. Gallen University for also your reactions, and then we will start with the questions and answers. So you have the floor, Wang.
Good afternoon, everybody. First, I would like to also congratulate WRF and RMI for this very detailed and exciting report. I come onto this from, as was mentioned, from the University of St. Gallen, and here at the Institute for Business Ethics, we are currently conducting research on the Swiss commodity trading sector. And so my remarks will really be focused also on what is it that we have found in relation to our own project that relate or link to the findings of the WRF. First, my comment is really more of a concern, the finding that there's really no real progress that has been made. As we have seen, the improvements are really minimal, particularly around the issue of due diligence. There is an expectation now that companies are required to know and show how they are identifying and addressing potential and actual human rights risks in their own operation and supply chains. And this report has just confirmed that, that is really not quite happening. That said, I think it's also important to mention, again, based on our own findings, that there's a difference across companies and across commodities. And again, in some of the commodities, we have found that, it is more developed than other commodities. So in that sense, this report also really augments our own data and which we find very useful for our purposes. My next observation relates to the question of financiers and investors and the role that they are playing in driving the adoption of due diligence practices. Yes, this report confirms that this is actually happening and tied, around to the ESG, the development around the ESG investment criteria. However, while this is positive, we ourselves have found that reliance on banks and other financiers, should not and does not provide us full security to anyone, because let's not forget that their primary aim is to de-risk their own portfolios. And so checking or the concern for risks on other stakeholders really comes at a really distant second. So that cannot really be a criteria for whether or not we are making progress. Thirdly, again, there's a positive finding that legislation does drive better practices. And yes, we have also found that even in our findings, that even the threat of legislation does help move the needle. So again, moving forward, perhaps we need to really look into what types of legislation that is actually needed. And lastly, on the question of transparency and public disclosure, again, as the report says that there is also positive improvements towards that. And there's also a call to encourage other companies to also move in that regard. In our own research, we have found that now companies are aware that they need to share more information with the public, and that the public is now a legitimate stakeholder. And this presents really an opportunity for institutions such as the WRF that are tracking these kinds of data to make it also more publicly available, because I think it will augment, again, what companies themselves are reporting. But at the same time, I think where we need to move to is just beyond, communicating and sharing of data, but it needs to be evident in this data, whether there is change happening or not. Those are my comments for now. Thank you.
Thank you, Wangi. So I think we had a very interesting, stimulating round of initial comments after the presentation of the report. And what stands out, of course, is that, as was said, there has been some improvement in some domains, but very significant gaps remaining. There is large variations between companies and with the best-in-class, and a great potential for progress. At the same time, we see large gaps between commitments and at least reports on actions and measures undertaken to translate commitments into concrete actions and remedial measures when needed. And I propose to pass to the Q&A. For the time being, I see one question, which I would like to raise to the panelists, is when we see the situation and the room for improvement that must be, this potential that must be really tapped into. What are the key measures to be undertaken, be it in terms of market incentives, be it in terms of regulatory measures or policy measures? And in addressing this, always interesting to tell us what your organization is doing to contribute to that, but also please, if you can highlight what would be, for you, the priority measures that should be undertaken as a matter of urgency to move up the ESG ladder. So with that, I propose, to keep the running order. So I would propose to have Nicole first, and then Juhani and Wangi just addressing this question.
Sure. So from our perspective, we started this back in 2017. We did our first consultation to the market. And really, we had initial reactions that said, this is not the role of an exchange. You know, you're here to facilitate trades and to create these prices, but your job is not to look into responsible sourcing and to do that work. That's for other people to decide. And that was some of our initial reactions to this consultation. But 2 years later, when we actually set the policy after a lot of dialogue and back and forth with market participants, we're not seeing that reaction any longer. So 96% of our producers last year decided to, send in their compliance information. So there was some initial reaction of saying this isn't the exchange's job, but when we actually set that, policy, we saw people decide to comply, and that it could be our role. So I think it's asking anyone who is working, in the trading space or in the metal space for us, oil and gas, of course, it was related to this report, what could be your role? And maybe breaking some of those barriers that before you thought maybe wasn't your role, seeing how you can have a positive impact. So that seems to have so far worked well, in the sense that we were able to have an impact on this and really move some of these metals to do this work that hadn't been doing it before. So I think that's my challenge, is to say, whoever you are, figure out where you can, move the needle, what is your role in this space. I think that's the main one. But of course, I'm really interested to hear Ioanni's comments on more of what the governments can do and regulators can do as well, because I think their role cannot be diminished. We can't put everything on companies. It also needs to be, a government action here. So love to hear your comments, Ioanni.
Thank you for the wonderful setup. It's not like we practiced it, but it works well. Thank you for the questions. I like that we're sort of being challenged a little bit in terms of what practically is being done and what can we do. I think this particular sector suffers from the fact that it is exceptionally complex, and regulators in sourcing countries that we work with and law enforcement in sourcing countries that we work with really struggle to understand all the complexity of this particular sector. And of course, if one was cynical, one would perhaps argue that it's designed that way for a purpose. But nonetheless, the challenges remain. And so there's sort of two broad directions that I would focus on. So first, on the enforcement side, of course, the key challenge is that government enforcement agencies in the natural resources space are designed to focus on the natural resources, not on the financial flows and not on the financial crimes, and their ability to follow the money, their ability to recover assets in their investigations are really, really limited. And so that's one thing that I think, especially in the commodity trading world, is particularly relevant, where money moves exceptionally fast. And so this is an area that we work with very closely. We also have a practitioners forum that meets on a monthly basis, focusing on follow the money activities specifically, where we bring together law enforcement agencies and civil society to build expertise in this particular space. And I'll paste a link to that forum and the next meeting to that forum in the chat. The second point here is that regulators themselves struggle to assess the corruption risks in this sector because their risk profiles are really quite rudimentary. And especially in a space that's so fast moving like commodity trading, even before we talk about critical minerals, but certainly once we include that, means that the risk profile needs to be updated on an almost hourly basis at this stage. Well, hourly, I'm exaggerating, but it needs to be updated much more frequently than it is, in fact, being updated now. And as a result of that, that means the control measures that regulators have in place are really outdated. They're, maybe 10 years old, 5 years old, and they don't reflect the current risk profiles that they face. And so the ability of regulators to manage their own corruption risks when interfacing with natural resource corruption risks broadly, but commodity traders more specifically, are really not reflective of the situation the way it is. If one only takes price factors that are swinging so radically over the last year and are likely going to change even more. If one would think, for example, that copper was a relatively utilized, underappreciated commodity that is suddenly becoming much more attractive. Never mind the price explosions in critical minerals. So all these factors are quite challenging. And one final point, if I may, which is that I think there is a sea change that I see emerging in the last year since the start of the Russian war on aggression in Ukraine, that has brought to the forefront not the extractives element of the commodity trading, but the grain element of commodity trading. Suddenly, commodity trading is becoming a much more mainstream term than it was ever before. And my hope is that that element of focus, that element of attention will bring an encouragement towards some more transparency, given the quite significant impact of this space. Thank you.
Thank you very much, Juhani. And we have comment questions also asking how much reputation is also a key factor that pushes companies to to look at risks and manage risks proactively with the proper due diligence. But I will turn now to Wangi with the same question on key measures, be it policy, regulatory, or market incentives that you see as playing a key role, a key driver to move up the ladder. So your turn, Wangi.
Thank you very much. In our study, we did look at both, I would say, a mandatory regulation as well as the market-driven approaches, which are mainly voluntary. And we found really that companies, as I said before, take mandatory regulation more seriously. And there are very many private regulatory initiatives that exist and that cover different commodities and different issues. But really, we found little evidence of their effectiveness, in fostering the kind of change that I would like. So one would really say that the market-driven approaches are really not working. But at the same time, and also presented in this report and in our own research, even areas where regulation or mandatory regulation exists, there are still gaps, and the practice is not yet there again to bring the change. But it doesn't mean that regulation is not important, but I think the question is what type of regulation do we need to craft to be able to really move the needle. And here we started looking, for example, at regulations that already exist covering different commodities. So, for example, there's regulation that exists that covers the 3GT, and again trying to see, because there's lots of research around there which also identifies the gaps that regulation has had in also trying to foster responsible business behavior. And I think from this existing regulation, we should be able to look at that, so that in this era where now we have more regulatory initiatives that are coming up, we make sure that we are learning and taking lessons from what is existing, so that we are not sort of repeating the same mistakes. That said, there are still challenges that exist because as we know, commodity trading, the sector is not homogeneous. The commodities themselves are so different and so varied, and so the question always arises, do you regulate per commodity? Do you regulate the whole sector? And these are issues that we need to think about even as we are coming up with regulation. But certainly, I think regulation is the way to go. But also, as Ioanni mentioned, very important is the issue of empowering the regulators themselves to be able to actually do that which they are expected to do. And oftentimes, we find that this is not the case. Thank you.
Yes. I think that there are a few other questions that might be appropriate for Robin to react. I think a set of questions was related to the selection of the 25 companies and maybe asking you whether you saw big difference in the level of information available or you could get between European, American or Asian-based companies. And the second was referring to something you did mention, the low-hanging fruits in the 4 domains. What could be done, quickly and easily to address some of the major gaps. So, Robin, over to you.
Thank you very much. Yeah, as I mentioned, first start with that last question. As I mentioned, the low-hanging fruits, these sort of easy win opportunities. And as was already mentioned here, I think one of probably the easiest and quickest opportunities, low-hanging fruits that we have identified would be to formalize those commitments. As we mentioned, there is still, which seems like a very basic start to formalize commitments, but we still are seeing a lack of information in those publicly sourced documents where we have actual commitments to some of these important issues on human rights and financial flows and the environment. So I think a really quick, easy, or maybe quick and easy low-hanging fruit would be to formalize some of those commitments. Again, as was mentioned, embedding supplier expectations in those contracts would perhaps even move the ladder further and help us help the suppliers know exactly what is expected of them. In the report, we have several pages of learning practices, some examples of some companies who have shown or provided information, publicly available information that shows exactly how they are doing various engagements with suppliers on human rights, also reviewing and improving their effectiveness on their grievance mechanisms, and really tracking and reviewing their performance. So I think that having this document library available to all could be really useful and this library can be queried, it can be searched, and companies, all trading companies could in fact go and see what their peers are doing and start doing that or improve on those steps that they are taking. Now, for what was the second question?
The second question, Robin, was really there were some questions with regard to your choice of the 25 companies, the criteria, and whether you saw huge variations and gaps in terms of the level of information available or that you could get, depending whether companies were publicly listed, private or state-owned, whether they were based in Europe, the Americas or Asia. So just to give us a bit more information, and maybe linking to this question, whether you see huge gaps also in the level of commitments and action taken between, but you mentioned you didn't see so many between state-owned, publicly listed and private companies.
Right. It's a good question, and of course, it's a natural one that we want to ask when we look at such a wide companies with a wide geographic distribution. But we really did not see very many patterns or trends within companies in different jurisdictions. It really is quite over the board, and this is really probably a reflection of then just the country-based, commodity-based, and regulatory environment in which these companies are operating. And so, yeah, we did not really see a whole lot of consistent trends. Yeah, so that being said, I think that this gives an opportunity for scrutiny of across the board, further scrutiny on all these companies. So yeah, we didn't really see any trends.
Thank you. I'd like to abuse my privilege as moderator to raise a question, possibly for Juhani or Nicole, I don't know. We know that commodity trade finance is quite important, and then you have a certain role for banks and financial intermediary. How much do you see the role of financial intermediary and commodity trade finance in managing risks in a proactive manner, including in the ESG area, and what do you see as progress or low-hanging fruits, or to the contrary, measures and policies that should be proposed and enacted? Who would like to take this question?
I've spoken first every time. Juhani, do you want to go first this time?
Please do.
Sure, I can give it a try. So I think it's hugely influential. I would perhaps raise two issues in this space. One is that traditional, if I can use that term, banks, I think are showing quite a bit of how do I put this, concern about the reputational risks. And I think we've seen that very much in terms of their willingness to finance commodity trading. I think this is overall a positive influence. Certainly the more pressure to sort of change the way the sector behaves or improve the way the sector behaves is welcome from my perspective. I think the one thing that remains to be seen is whether the potential, or in some cases actual, withdrawal of financial institutions from this space for concerns or for reasons of risk tolerance will not lead to other financial institutions such as private equity or others replacing them, in which case, of course, there's sort of a net zero effect. So I think it's it's sort of a complex and moving target. I don't have a sort of ready-made solution here either, unfortunately.
No, agreed completely, Juhani, on that point. That's one of the concerns we see is this de-risking approach, is that they just want to de-risk their supply chains, and then someone else comes up behind them who maybe isn't as advanced in their due diligence or has different values that comes and replaces that entity that was doing that funding. So our goal is really on engagement, and that's what the OECD's guidance document is that we use, is really about how do you engage, how do you change the practices and keep them in your supply chain. But obviously that's really risky, because then they're reputationally exposed that they are still engaging with this, entity or this region or whatever it may be. So we're trying to keep that conversation really high in people's minds. This is about engaging and changing practices. It's not just about de-risking. And that's one of the issues with how we see financiers approaching the problem. But the good news is, we see progress on this as well. So for instance, at the LME, we have something called LME Passport, which is trying to kind of address that lack of transparency in the metal supply chain, where we have this open public platform, a database of ESG metrics that different producers can put all of their data on there when it comes to ESG performance. And one of our main audiences is the finance world. So they can go onto that and see a little bit more what they're supporting and who are they supporting and what are those current practices. And they can engage with that producer and ask them and challenge them a bit more. So that's what we really want to see, is engagement versus de-risking. But I understand that at a company perspective, that puts you at a bit more of a risk on that reporting side. So it's a balance here. This is a tightrope, and there's no kind of easy answer for that one. But that's kind of our kind of mentality and how we approach the challenge.
I see a question that maybe we direct address to you, Wangi. It's a comment and a question saying that there is a lot of focus, of course, on companies, but the comment is that situation varies a lot between contexts, and especially in weak governance contexts or fragile contexts, we call them. And the comment says that entities like the International Finance Corporation, the World Bank, especially need to focus less on companies, but more on technical and moral accountability of governance, meaning governance also in the host countries, in the commodity-dependent countries. So indeed, I think we have discussed that each actor, each stakeholder has a certain role and responsibility and can contribute. But how do you react to that comment that was placed, Wangi?
Okay, thank you. Specifically, as I said earlier, our research really was focusing on Swiss commodity trading companies. However, of course, we did come across this challenge of weak governance in producer countries, and there are a host of measures that are being taken. It's not that everything is not happening. For example, we do see some of the commodity specific laws that are very specific to these zones. And again, as the author of the question has said, again, even those governments also need support in terms of enforcing those laws, and also sometimes the governments, even in those countries, also do have their own laws, but also struggle to implement them. And I think the solution is really not just one-sided. So perhaps it's not to say let's stop focusing on companies and let's focus more on governments, because the companies are operating, within this context. And so it's not just governments that need to change, but also companies need to be aware of how is it that their operations perhaps make the situation more fragile, or how is it that they can contribute to improve the situation. Yeah, so it's not just focusing only on the countries, but I think it has to be a push from all the different directions. Of course, if everything worked perfectly, then perhaps we wouldn't be having this conversation. But every lever actually needs to be moved. Thank you.
Well, thanks a lot. Time is flying. We have to wrap up. So to wrap up, I propose to challenge you with one question. What do you want to see as a matter of priority in the next iteration and next edition of the report? So let me go back to our three panelists and then to the author and Helen. But for that, I give you maximum 30 seconds. Less is even better. And just what is the thing you want to see in the next report compared to the first two editions? Nicole, may I start with you?
Let's go on that effectiveness question. How can we measure more about the effectiveness?
More measure and better measure of effectiveness. Thank you, Nicole. Go on with Johanni.
Well, I would like to see, as a result of it, more public scrutiny of the sector, which seems to be increasingly out of sync with the overall public expectations for transparency and accountability.
More public scrutiny. This is yours. Then Wangi, what is your take on it for the wish you have for the next iteration?
I think a deeper look into grievance mechanisms, and I say this because I think if we have more information around how the grievance mechanisms work, then we will also be able to know whether the due diligence is also working or not. If this information is available, I think it would give us a little bit more to work with. Thank you.
Yes, grievance related to due diligence. We did not discuss a fully relationship with the UN guiding principle of business and human rights, but certainly this is part of it. Robin, if you are again an author of the next report, so what will you do?
Well, among all of these issues brought up here, which are all very, very important, I being with an environmental background, I would like to see more emphasis on some of these very important environmental issues. We are facing incredible challenges in the environment, not to mention climate change, but also things like biodiversity. And I think the environmental aspects, I think, could be looked at in greater detail, because this is going to be important in the future. Thanks.
Great. Then, Helen, you've been in the sector for a while. What would you like to see in the third edition? And if I may ask Ellen to speak close to the microphone because to get a better sound of your voice. Thank you.
I hope this is better.
Yeah.
Picking up on the effectiveness wish and also greater public scrutiny, I just would like to remind, especially companies, but also regulators and the trade finance people, that public interest data belongs in the public domain. That's how one builds trust. That's how we build stronger, resilient systems. I'd like to see more of that. Thank you.
Thanks a lot. Well, with that, we are reaching the end of our webinar. I'd like to thank, of course, and commend the authors and organizations who have, brought to fruition the second edition of the report. And I'd like to thank all the speakers, panelists, for being with us, and also all the participants and those who have raised comments and questions. I think you have a wealth of sources and further documentation and information that you can find on the website and through the report. Very useful resources, which I recommend all of you to consult and use in your research, in your policy work, and also in your practical business work. And if I may have a wish myself, of course, it's really also to have the next time the commodity traders themselves being able to voice their own wishes, and we know about some of their challenges, but their own wishes, and to see how we all progress together, because this is, as we heard, a very much multi-stakeholder, multi-layered endeavor. It's complex, but there are a lot of room for improvements. It's feasible, it's been done, and I think it's in the best interest of all the stakeholders involved. So with that, thank you all. I wish you a good end of the day, and I look forward to seeing you in 2 years for the third edition. Okay, bye-bye.
Thank you so much.
Bye-bye, everyone.
Bye.